Now, as we look in the structure of the portfolios, and this is really true generally across the board, one, I think it's important to recognize that our portfolios are anticipatory. I mean, they're really there to look to the future. So over the last 12 to 18 months, as we have been reducing the equity allocation, and we don't reduce it by huge amounts at a time, we might be doing 2 or 3 or 4 or 5%, but as we begin to do that, we've been addressing the higher valuation in the equity markets. We've tried to stay away from lower grade bonds by staying on the investment grade side, avoiding the longer term exposure because of where interest rates are at, and basically adding products that are inverse to treasury prices as well, and that's the TBT, which is something that most of you hold. We've added inflation protected bonds, which is your TIPS, commodities and gold positions. They have helped us through the the volatility of the market to hold the value of the portfolio better than if we were strictly in straight stock and bond positions. Because of the weakening dollar, adding international bonds, international stocks, and that's not adding more stocks to the portfolio, it's really replacing some of our other stocks, such as smaller companies who we believe will struggle a little bit more in this type of environment than your larger companies who one, have deeper pockets, but they also have international elements to them. We've added hedged equity products, which are really low correlation assets to the stock markets. They have supported the portfolio very well, and in one case, which is Hussman, Hussman's been up about 4% over the last, about not quite the last 30 days, really through about the last 15 days, whereas the equity markets are down about 12 or 13%. So it's done its job in the portfolio. It has a place, and as always, we're following a long-term investment strategy. We don't know on a day-to-day basis what the market's going to do, but by using some of the statistics and data that we have available, we believe that we can put together a strong strategy going forward. So as we've kind of evaluated the market, that's why at this point you see a lot more things in your portfolio today than what we had in the portfolio 3 or 4 years ago. So that's kind of, as we kind of summarize this, it's really been a challenging environment for investors and for our clients because of the volatility. I know no one really likes to see big down days because they know what that does to the portfolio. But I think most of what is going on right now is driven by emotions and the uncertainty. And if we sometimes just being patient and allowing the portfolio to do the work that we've designed it to do, sometimes being patient is the best strategy. So trying to time in or out of the market is always difficult to do, and we think that the structure that we've got in place has really helped us through the volatility and the uncertainty. So with that, I guess I'd like to open it up to whatever questions that anybody has. And if you do have a question, if you want to raise your hand, or if you want to just type a question in the question box, we'll be more than happy to announce that question and answer it as well. I think there's one question that we have gotten quite a bit. Well, not quite a bit, a few times, and it's really in relation to the run-up in gold. The question has really been along the lines of, hey, we've had this big run-up in gold. Why don't we sell the gold position and buy stocks or buy something different? And I guess I wanted to have Brian address that because, again, a lot of times when we hear the question a couple of times, it probably means that other people have it on their mind as well, especially since gold's getting a lot of attention.
And that is a fair question, especially when you look at the divergent charts between gold and stocks, how just in the last month gold has shot up while stocks have fallen off. And so our view here is that that would not be an advisable strategy at this point. The reason we hold gold in the portfolio is due to the fiscal concerns that we have outlined before. And as we've mentioned, those fiscal concerns, those monetary concerns, are just getting started. They're still in the early innings. If there were some clue or some hint that those would have some resolution on the horizon, then we could be persuaded to start looking at an opportunity to take some money off the table with gold. But for now, the case is too compelling. And it's not just a sentiment argument right here. We know that gold is volatile. We know that gold will fluctuate up and down, much like stocks. But there are some different metrics. If you look at, for instance, the shadow price of gold, which, for instance, going back to Bretton Woods, whenever the U.S. was on the gold standard, if you use the exact same formula that we used then, where gold supported the entire monetary base of the United States, you'd get gold price somewhere close to $10,000 an ounce today. Currently, the spot price of gold is somewhere closer to $1,700 an ounce. That's obviously a very disparate amount. We don't anticipate necessarily that gold will go to that amount, and we don't target price where gold will go, but we do believe that there is significantly enough concern with the deficits and the debt that we need to have that insurance of the gold in the portfolios currently. And we don't have a disproportionate weighting in the portfolios yet to merit, we believe, a trimming of the gold position.
You know, I think there's one other way to look at it, and just a little analogy for you. If you think about it like a gas pedal and a brake, you know, as the government continues to put the gas on, which is the fiscal stimulus, the injection of liquidity into the markets, as they continue to put that gas pedal on, we're inclined to put that brake on because of the potential for the debasing of the dollar. And so while we haven't seen them let up on the gas at all yet, if they do, we would be more inclined to let up on the brake to counterbalance their activity. I do have a question, and the question is, at what PE ratio would we recommend adding to equity positions?
Sure, and that's a good question. We would start getting more interested in adding to positions when PEs get below 12, and we would be extremely interested if PEs got below 10. I think at that level, we would be very interested in getting to full weight on our equity positions. Now, that obviously is pending whatever else might be changing in the economy as well.
I mean, I think in each case, I think it's situational, and you know, while we have some general areas where we really like to add and where we really want to trim, it's taken in the context of other things around it as well. Are there any other questions that anybody either can type into the question box, or again, we can open the mic up if you'd like, and we'd be more than happy to answer more questions. Okay, certainly, one, we thank you for joining us this afternoon, taking a little bit of time out of your afternoon to learn a little bit more about our current positions and what we're thinking. Secondly, well, hang on a second. I got another question. Okay, the question is this an opportunity to trade more frequently to take advantage of short-term gains?
So that's the trade-off, isn't it? Whenever you see the market gyrate like it is, there are times where you feel like, on a technical basis, the market might be oversold or it might be overbought. So that's certainly the temptation I think from a valuation perspective, it gets much harder to justify taking such actions with a long-term asset because then you start to change the reasoning for your purchase or your sales of the asset. And so if you can anchor your purchase and sell decisions in valuation, then when things get scary, when things get emotional or even frothy in the opposite camp, you can maintain your moorings, and it is easier to make a sound and unemotional decision that will benefit you longer term. Once you start to make trades based on a technical basis, invariably the market will fool you and make some decisions that are seemingly irrational at the time. And it does that. It does that frequently because sometimes, you know what, the market goes down just because it went down, and it went up just because it went up. But that's the reason we really find that anchoring our decisions to actual valuation and fundamental metrics really improves the odds of better long-term performance.
Good question. Any other questions? If not, again, we do thank you for joining us this afternoon. And certainly, if after we get off the line, if you have any questions, that you want to ask specifically, maybe for your own situation, we're certainly more than interested in helping you out with that. And with that, we'll close up and wish you a good evening, and we will certainly talk to you soon. Bye now.